Welcome to the deep dive. We're here to take some really complex, sometimes seemingly unrelated ideas, things like behavioral psychology, financial modeling, even urban planning and negotiation tactics.
And weave them together.
Exactly. Synthesize them into a single, usable blueprint.
And today, our goal isn't just about, general success. It's about intentional success. We want to get past the surface level tips.
Right.
And really understand the underlying systems, the habits, the market forces that actually shape long-term wealth and, frankly, personal effectiveness.
That's a really important distinction, intentional. We're trying to connect the dots, aren't we?
Right.
Between like your internal operating system, your identity, your habits, and then the external stuff, the mechanics of real estate markets, regulations, how investments actually work.
Because, and this came through so strongly in the sources, long-term success, it's not just about what you do out there in the market.
No.
It's fundamentally about who you are when you show up. It has to start from within. That's the foundation.
Okay, so let's start right there with that internal architecture. One of the biggest ideas, maybe the most critical, is something that sounds simple but is actually quite profound.
Which is?
That behavior just won't stick if it doesn't align with your core identity. If it's incongruent.
It just won't last. You can force it for a bit, maybe.
Yeah, willpower, right.
Yeah.
But eventually.
Eventually, you snap back to who you believe you are. Think of it like the engine of a car, not just the paint job. Your identity. That's the core belief system driving your habits.
Give us an example.
Okay, so if deep down your self-perception is, I am someone who consumes, right, buys things, enjoys services,
Okay.
your actions will just constantly pull you towards spending. Even if you set these ambitious savings goals, you'll find little justifications for purchases because, well, that behavior reinforces your identity as a consumer. It feels right to you.
And the flip side holds true. If you see yourself as a creator, an investor.
Precisely. Or think about comfort versus accomplishment. If your identity prioritizes immediate comfort like, I deserve a break, I work hard, now I relax.
Which sounds reasonable.
It does. But if that's the core identity driving you, you'll constantly find yourself drawn to the couch, chilling out exactly when your plan says you should be analyzing a deal or making calls.
So real change isn't just setting a new goal.
No. It's not a process you follow externally. It's a fundamental shift in the answer to the question, who am I? That's the bedrock.
That really reframes things, especially when we think about financial goals, like achieving financial freedom. The sources we looked at use that classic four-quadrant model.
The ESBI quadrants, yeah.
Employee, self-employed, business owner, investor. If your identity hasn't shifted, you're essentially stuck in the wrong quadrant for your goals.
Absolutely. Think about traditional education, school, university. It's almost perfectly designed to create highly effective E's and S's employees and self-employed people.
It teaches you to trade your time for money.
Exactly. Work for a boss or work for yourself, but you're still selling hours. Now, true scalable wealth build-out, the kind that actually gives you time back, that demands a shift, an identity shift, a skill shift towards B or I.
Business owner or investor.
Right. Moving from trading your finite hours for dollars to building systems that run without you, or leveraging capital so your money works for you.
That sounds like a tough transition.
It is tough because it means letting go of that stable, understandable identity of being a worker and embracing the uncertainty, the leverage, the mindset of an owner or a capital allocator. Big leap.
Okay, so let's say you make that leap. You adopt a new identity. I am a long-term investor, for example. How do you make that belief translate into consistent, reliable action?
Well, that brings us squarely to habits, doesn't it?
Naturally.
A habit is basically the brain's way of solving recurring problems efficiently. It's lazy in a good way. It wants to save energy.
It automates solutions.
Exactly. It's just a behavior you repeat often enough that it becomes automatic. And the way we build them is through this constant little feedback loop. You try something.
You probably mess it up, or it's inefficient at first.
Inevitably. You fail, or you learn something isn't quite right. That's the feedback. Then you adjust, try it differently.
And over time.
The useless bits, the wasted energy, they gradually fade away. The actions that work, that get the result, they get reinforced, they get smoother, faster, until boom, it runs on autopilot. Minimal conscious thought needed.
And to kind of engineer that process, to build good habits deliberately, the sources point to that really powerful framework. The 4 laws of behavior change. I think we should unpack these a bit.
Yeah, they're like the checklist for building better actions. Really practical. The first one, make it obvious.
The cue, the trigger for the habit, has to be right there in your face, hard to miss.
Exactly. That's why techniques like habit stacking work so well. You link the new habit you want to build onto one you already do without thinking. Like, after I pour my first cup of coffee that's your existing habit, I will spend 15 minutes reviewing my investment dashboard that's the new habit. The coffee is the obvious cue.
Okay, makes sense. Law number 2, make it attractive. You actually have to want to do it, or at least not dread it.
Right, and this isn't just about raw willpower. It's about making the process itself feel rewarding somehow. Anticipation matters.
How do you do that if the habit is, well, kind of boring, like bookkeeping?
Yeah, the classic example. Often it involves temptation bundling. You pair an action you want to do with an action you need to do. So maybe you only listen to your absolute favorite podcast while you're doing your weekly expense tracking.
Ah, so you link the reward directly to the less attractive task.
Precisely. Your brain starts to associate the difficult habit with the pleasure of the podcast. Makes it more appealing.
Okay, number 3. This feels like a big one. Maybe where a lot of people fall down, especially with things like New Year's resolutions. Make it easy.
Oh, absolutely critical. If you pick a new habit that requires a huge amount of effort right out of the gate, you're setting yourself up to fail. Too much friction.
So the key is,
Lower the barrier to entry as much as humanly possible. The sources talk about the 2-minute rule.
the 2-minute rule.
Yeah. Basically, when you start a new habit, it should take less than 2 minutes to do.
Seriously.
2 minutes.
Seriously. If your big goal is run a marathon, the 2-minute version isn't run 5K. It's put on my running shoes and walk out the door.
Okay.
If your goal is write a book, the 2-minute version is open my laptop and write one sentence. You make the starting ritual so easy, so frictionless, that you can't not do it. Momentum then helps carry you forward.
That's clever. Reduces the intimidation factor.
Hmm.
Okay, and the last law, make it satisfying.
Yep. Connects right back to that identity piece we started with. The habit needs to deliver some kind of immediate reward or positive feeling.
Why immediate? Because our brains are wired for immediate gratification. Long-term benefits are too abstract. If you're trying to save money, the satisfaction isn't just seeing your account balance grow next month. It needs to be the immediate feeling of pride or accomplishment you get right after you track your spending or make a conscious choice not to buy something. That little dopamine hit reinforces the behavior.
So, obvious, attractive, easy, satisfying, that's the loop.
That's the loop. It reinforces the identity, builds the habit, makes the change stick.
Okay, so we have the identity shift, we have the habit mechanics. Now we need a system to execute, to actually get stuff done consistently. This is where that concept of the 12-week year comes in. It challenges the whole idea of annual planning.
Yeah, it really does. And for good reason. Annual plans, honestly, they often fail.
Why? They seem standard.
The time horizon is just way too long. Think about predicting specifics 6 months, 9 months, a year out. The level of uncertainty is massive. It makes detailed, actionable planning almost impossible. It's like trying to predict the weather next October.
So the 12-week cycle shrinks that uncertainty.
Dramatically. It brings the deadline close enough that you feel the urgency, but it's still long enough to achieve something significant. It forces you to translate those big, vague annual goals into concrete weekly actions you can actually execute now.
So how does the execution work day to day or week to week within that 12-week sprint?
It demands a really focused, almost ruthless prioritization. You have to identify the handful of truly vital actions that will actually drive results towards those 12-week goals.
And manage that through.
Primarily through the weekly plan, and this is crucial. The weekly plan is not just a glorified to-do list. It shouldn't be cluttered with busy work.
Like answer emails or attend meetings.
Exactly. It needs to reflect only the critical, high-leverage strategic activities, the things that, if you do them consistently, will guarantee progress on your main goals. Think contact 5 potential investors versus clear my inbox. Big difference.
And the focus is on consistency, not necessarily feeling motivated.
100%. The system has to run on process, not passion or discipline surpluses. You execute the plan whether you feel like it or not. That's how you build momentum.
The sources mentioned a critical window within that 12-week period.
Yes, the first 4 weeks. They are absolutely non-negotiable. You have to dedicate that initial period to embedding the 12-week year as your primary execution system, establishing the routines, the tracking, the new habits we talked about.
If you fumble those first 4 weeks,
the whole thing tends to fall apart. You lose momentum, the old habits creep back in. Getting some early measurable wins in that first month is key. It builds belief, makes the final goal feel achievable. It's a psychological anchor.
All right, so we've built the internal engine, the mindset, the habits, the execution system.
Yeah.
Now let's shift focus outwards to the world of finance and real estate investing. The sources were really clear on this. You can't jump into investing without getting your own house in order first.
Absolutely. A solid personal financial foundation is prerequisite number one. You need an accurate picture of your current situation, that's the net worth snapshot. You need a plan for your money, that's the financial spending plan or budget, whatever you call it.
And you need positive cash flow personally, either saving consistently or actively working to earn more.
Non-negotiable. Trying to invest when your personal finances are shaky is like building a house on sand. And speaking of earning, the data on income generation today really flips an old script.
What script is that?
The whole idea of the idle rich lounging around while the masses toil.
The old stereotype.
The data actually shows the opposite trend now, especially at the top. Our sources cited some pretty eye-opening stats. Among the top 6% of income earners in the U.S., 62% work more than 50 hours a week.
62%.
And get this, 35% over a third worked more than 60 hours a week.
Wow. So the highest earners are often working the hardest.
In many cases, yes. They are highly focused on work, on accumulation. It kind of shatters that image of effortless wealth, doesn't it?
It really does. So the goal then isn't necessarily just to stop working, but maybe to work smarter, like converting that hard-earned income.
Exactly. Converting that earned income, which is typically taxed at the highest rates,
Right.
into passive income, like from rentals, or portfolio income, like from stocks or business equity, which generally enjoy much more favorable tax treatment. That conversion is the engine of wealth acceleration.
Getting out of that ERS quadrant thinking, trading time for money, and into the I quadrant, the investor quadrant.
That's the strategic move. Make your capital work for you, not just your time. That's the path to real financial freedom, having your assets generate income.
Okay, let's get tactical then. Let's talk rental properties, specifically for the buy and hold investor. What are the absolute must-know factors when you're analyzing a potential deal?
Two things stand out above all else: cash flow and appreciation.
Define those quickly for us.
Cash flow is king for buy and hold. It's the actual money left in your pocket each month or year after you've paid all the bills: mortgage, taxes, insurance, property management, vacancy reserves, maintenance reserves, everything. It's the immediate return.
And appreciation.
Appreciation is the increase in the property's value over time. It builds your equity, your net worth. But experienced investors often treat it as like the icing on the cake.
Why is that? Isn't appreciation where the big money is?
It can be long term, but it's notoriously difficult to predict accurately, especially in the short run. Market swings happen. So the mantra is often, you invest primarily for the cash flow, which pays the bills and provides income now. You hope for appreciation, and you gain wealth passively through that and the loan being paid down over time.
Okay, so focusing on that immediate return, the cash flow. How do we measure how efficiently our invested cash is generating that flow?
That's where cash return on investment, or CUCO CRI, comes in. It's a really clean, really important metric.
How's it calculated, and why is it so useful?
Simple calculation. It's your annual cash flow, that net money left over, divided by your total cash invested.
Total cash invested,
Meaning your down payment, your closing costs, any immediate repair or renovation costs you paid out of pocket, basically every single dollar of your own cash that went into acquiring and stabilizing the property.
Got it. So if I put in $50,000 cash total, and the property cash flows $6,000 a year after all expenses.
Your COCROI is $6,000 divided by $50,000, which is 0.12, or 12%.
And the power of this metric is its purity.
Exactly. It strips away other factors. It deliberately excludes appreciation. It excludes the principal paid down on the loan. It excludes potential tax benefits. It just answers one simple question. For every dollar of my own cash I put into this deal, how many cents am I getting back each year in actual spendable profit? It's a direct measure of your cash's immediate performance.
Very clear. Now, looking further out, how do investors estimate what a property might be worth down the road, say, if they plan to sell in 5 or 10 years?
That's where valuation using the capitalization rate, or cap rate, often comes in. It's especially common for commercial properties or apartment buildings, but the principle applies more broadly.
How does that work?
Okay, so first, you need to estimate the property's likely net operating income, or NOI, in the future year you plan to sell. NOI is your gross rental income minus all your operating expenses, taxes, insurance, management, maintenance area. But crucially, it's before you account for your mortgage payment, debt service.
Okay, so income minus operating costs, but not financing costs.
Correct. Then you need to estimate what the prevailing market cap rate will be for similar properties at that future time. The cap rate essentially represents the rate of return that a typical buyer in that market expects to receive on their investment based on the property's NOI.
So it reflects market sentiment and risk.
Exactly. Lower cap rates generally mean higher property values. Buyers are willing to accept a lower return, often because the asset is perceived as safer or having more growth potential, and higher cap rates mean lower values. So if you estimate your future NOI will be, say, $20,000 a year, and you believe the market cap rate for that type of property will be 8%.
You divide the NOI by the cap rate.
You got it. $20,000 divided by 0.08 gives you an estimated future selling price of $250,000. It's a way to project value based on expected income and market conditions.
Okay, let's shift to getting deals done, acquisition strategies. The BRRR method is super popular online. Buy, rehab, rent, refinance, repeat. Sounds amazing, but where's the catch? What are the risks?
The biggest point of failure, the place where investors really get stuck, is the second, or the refinance.
Why?
Because it depends on things that aren't entirely in your control. The property has to appraise for a high enough value after the rehab to allow you to pull most or all of your initial investment back out if the appraisal comes in low.
You're stuck.
You're stuck. Or maybe the appraisal is fine, but your financial situation changes. Your credit score drops, your income verification gets tricky, lending standards tighten up. Suddenly, you can't qualify for the refinance loan you were counting on.
And that's especially dangerous if you use certain types of initial funding.
Hugely dangerous if you used short-term, high-interest financing like hard money for the purchase and rehab. Those loans often have terms of just 6 months or a year. If you can't refi out by then, you could face massive fees, default, or even lose the property.
So the lesson is,
Always have multiple exit strategies planned before you buy. Don't rely solely on the refinance working perfectly.
what's a typical backup plan?
Well, if the refi fails, can you pivot quickly? Could you sell it as a fix and flip instead? Is the projected rental income high enough to at least cover the payments on the existing more expensive debt until market conditions improve, or you can qualify for better financing? You need plan B, plan C. The sources stress this. Planning for failure isn't pessimism, it's realism. It turns a potential catastrophe into just a manageable detour.
That makes sense. Beyond BRRR, we also saw some really interesting creative ways to finance deals, moving beyond just getting a standard bank mortgage. Let's talk about the self-directed Roth IRA. That sounds powerful.
Oh, it's incredibly powerful, especially for long-term tax-advantaged growth. A self-directed IRA, specifically a Roth IRA, lets you use your retirement funds to invest directly in alternative assets like real estate.
And the benefit of the Roth structure.
Money goes into a Roth IRA after you've already paid income tax on it. But here's the magic. All the growth inside that account, rent income, appreciation when you eventually sell the property held within the IRA, grows completely tax-free. And assuming you follow the rules, all withdrawals in retirement are also completely tax-free.
No capital gains tax, even on huge profit.
Correct. The sources gave an example may be extreme, but illustrative of an investor who sold a real estate asset held inside their Roth IRA for a profit exceeding $1 million. That entire $1 million gain. Zero tax owed upon withdrawal in retirement. Imagine the difference that makes over decades.
That's a massive advantage for wealth building. Okay, what about needing money really, really fast, maybe just for a few hours? We heard about transactional lenders.
Yeah, transactional funding is a niche but crucial tool, mostly used by real estate wholesalers.
Wholesalers being?
People who find undervalued properties, get them under contract to buy, and then quickly assign or sell that contract or the property itself in a double closing to another investor, the end buyer, for a profit. They often don't intend to hold the property themselves.
So they need funds just to bridge the gap.
Exactly. Sometimes they need to actually close on the purchase, deal A, before they can immediately resell it to their end buyer, deal B, just minutes or hours later. This is called a double closing or simultaneous closing. Transactional lenders provide the funds needed only for deal A, just for that very short period, knowing they'll be repaid instantly when deal B closes. It's very short term, usually high cost, but it facilitates deals that wouldn't happen otherwise.
Got it. And one more creative strategy. Seller financing. We usually think of this benefiting the buyer, maybe someone who can't easily get a bank loan. But how does it help the seller?
That's often overlooked. Seller financing, where the seller essentially acts like the bank and carries the mortgage note for the buyer, can be fantastic for the seller too.
How so?
Well, first, it can open up their property to a much wider pool of potential buyers, potentially getting them a higher sales price. Second, instead of getting a lump sum of cash, which then needs to be reinvested, they receive a steady stream of monthly income, the mortgage payments from the buyer, including interest.
So it converts the property into an income stream.
Exactly, often at an interest rate higher than they could safely get elsewhere. And crucially, they get this income without the headaches of being a landlord. No maintenance calls, no tenant issues, they just collect the check. It can be a great way to transition out of active ownership while still generating passive income from the asset.
Okay, we've covered the internal game mindset, habits, and the financial mechanics. Now let's look at the physical world these properties exist in and the rules governing them. This section really dives into some heavy but crucial history, particularly around housing segregation. The sources highlighted the role of the Federal Housing Administration, the FHA.
Yeah, this is really fundamental context for anyone investing in American real estate or, frankly, anyone living in an American city.
Yeah.
The FHA, starting back in the 1930s with its underwriting manuals, well, it played a major role in shaping the segregated landscape we see today.
How specifically?
The manuals explicitly guided lenders. They actively discouraged making loans in older, often urban, and frequently minority-occupied neighborhoods. They literally called these areas hazardous or on a downward trajectory.
And favored.
They favored loans in newer suburban areas, and the guidelines specifically mentioned the importance of natural or artificially established barriers, things like highways or parks that would prevent the infiltration of lower-class occupancy and inharmonious racial groups.
Wow. That's direct language from government policy.
It's incredibly direct. This wasn't subtle. It was systemic redlining, drawing lines on maps around minority neighborhoods, and deeming them ineligible for the government-backed mortgages that were fueling suburban growth, especially after World War II. Capital was deliberately channeled away from diverse urban cores and towards homogeneous, often white suburbs.
And the long-term impact of that.
Devastating and persistent economic segregation. The data is stark. Between 1970 and 2009, the percentage of poor families living in concentrated poverty neighborhoods more than doubled, from 8% to 18%.
Oh, wow.
And on the flip side, affluence became entrenched. One statistic was that 80% of neighborhoods that were affluent in 1990 were still affluent 2 decades later. Your ZIP code became increasingly predictive of your life chances, your economic destiny.
And this concentration happens more in certain types of cities.
Yes, the sources noted correlations. Segregation of the poor tends to be higher in larger, denser metropolitan areas, and also in cities with big concentrations of high-tech industries, the so-called superstar cities. Understanding this history of how capital flowed or was prevented from flowing is critical for understanding current property values, neighborhood dynamics, and investment opportunities or challenges.
Absolutely crucial context.
Yeah.
Now let's zoom in on the buildings themselves. There's often confusion in how we talk about homes, the difference between architectural styles and building types. Can you clarify that?
Yeah, it's a common mix-up, but important for clear communication, especially if you're talking to architects, contractors, or even savvy buyers. A true architectural style refers to a whole system of design principles and characteristic features from a specific period or movement, think Greek Revival, with its columns and pediments, or Italian villa, with its low-pitched roofs and towers.
So it's about the overall design language.
Exactly. A building type, on the other hand, just refers to the basic form, the shape, the massing of the structure itself. Common examples are the saltbox shape, the Cape Cod form, or the bungalow.
So Cape Cod isn't technically a style.
Right. It's a type of house, typically symmetrical, 1.5 stories, steep roof. You could theoretically apply different stylistic elements to a Cape Cod form, though usually they're fairly simple. But people often use style and type interchangeably, which can lead to confusion when discussing renovations or historical districts or market appeal. Knowing the difference helps you speak the language more accurately.
And speaking of regulations, this ties into American zoning philosophy. How has that shaped our cities?
Profoundly. The sources point out that typical American zoning gives an incredibly privileged, almost dominant position to one specific building type, the detached single-family home.
Really, how dominant?
Often, something like half of all the residential land in a city is zoned exclusively for single-family detached houses. This philosophy, which rigidly separates land, uses housing here, shops over there, industry way over there, is deeply ingrained.
And this runs counter to other ideas about city planning.
Directly counter to the ideas championed by critics like Jane Jacobs decades ago. She argued passionately for mixed-use neighborhoods where homes, shops, workplaces, and public spaces are intertwined. She believed this mixing created safer streets, more vibrant communities, and greater economic opportunity. But the single-family zoning model largely won out, shaping the suburban sprawl and often car-dependent landscapes many of us live and invest in.
Okay, let's get down to the practical nuts and bolts of managing properties. When you're getting a rental ready for a new tenant, what are the absolute must-dos?
Rule number one. The property has to be truly move-in ready. That means completely empty of the previous tenant's belongings, professionally cleaned top to bottom, all necessary repairs completed, and everything fully functional and up to local housing codes. No excuses.
And beyond the initial turnover, what's key for saving money long-term?
Proactive maintenance, especially on the small stuff. This is where inexperienced landlords bleed money. Take a simple dripping faucet. It seems minor, right?
Yeah, annoying but small.
That slow drip can waste hundreds of dollars in water bills over a year. And the fix. Often it's literally a 50-cent rubber washer and maybe half an hour of work. Ignoring small leaks, using cheap plastic plumbing fixtures that break constantly, putting off minor roof repairs, it's a completely false economy. You have to fix small problems immediately and use durable, quality materials, even if they cost a bit more upfront. It saves massive amounts down the line.
Okay, good advice. Now, what about the difficult side? Problem tenants. Eviction seems like a nightmare.
It absolutely is. Eviction is time-consuming, it's stressful, it can be incredibly expensive with legal fees and lost rent, and the outcome isn't always guaranteed. It's really a last resort.
So what's the smarter approach if a tenant is consistently causing issues, maybe late payments or minor lease violations?
If the problems are persistent, the simplest, cheapest, and often fastest method, according to the sources, is simply to not renew their lease when the current term expires.
Rather than trying to build a case for eviction during the lease term.
Exactly. Trying to evict mid-lease for anything other than non-payment of rent can be legally complex and drag on forever. Just letting the lease run out and giving proper notice of non-renewal avoids most of that legal entanglement and cost. It allows you to regain possession of the property cleanly and find a better tenant. Obviously, non-payment is different. You may have to act faster there. But for other chronic issues, non-renewal is often the strategic move.
Okay, switching gears to selling a property. Staging came up as really important. It's about more than just cleaning, right? It's emotional.
Totally. Staging is essentially theater design for houses. It's about creating a feeling, an aspiration, helping buyers emotionally connect with the space and imagine themselves living there.
So where does that start? First impressions.
Absolutely critical. The entryway, the moment someone walks in the door, sets the tone for the entire showing. The sources called it the entree. It needs to create a positive expectation. Inside, the goal is flow. You want streamlined furniture layouts that don't block pathways, that draw the eye through the space, and physically pull buyers into the rooms. Let them move easily and picture placing their own furniture. Clutter is the enemy of imagination here.
What about specific, maybe overlooked high-impact details?
Light. Maximize natural light at all costs. This means professionally cleaning the windows, inside and out. It sounds minor, but for a few $100s, maybe $200 to $500 for an average house, it can make rooms feel dramatically brighter, larger, and cleaner. It's one of the best ROI staging investments.
Anything else on the exterior?
Power washing. Cleaning the siding, the porch, the walkways, again, relatively low cost, huge impact on curb appeal, and that first impression makes the whole place look cared for.
Inside, what about kitchens and specific decor choices?
Kitchen counters. Ruthless minimalism. The rule of thumb was 3 items maximum visible on the counters. Put everything else away. It makes the kitchen feel bigger and more functional. And then rugs. Be very careful with rugs.
Why rugs?
The sources were quite direct on this. Strongly colored rugs, or traditional Oriental-style rugs, can subconsciously make a house feel dated to many buyers. The quote was, "They speak of age and therefore dirt in grandparents' homes." Harsh, maybe, but it reflects a common buyer psychology. Neutral contemporary rugs are generally safer.
What about painting? Accent walls.
If you do an accent wall, don't just pick a random bold color. To keep it feeling balanced and intentional, either pull a color directly from something else in the room, like the pattern in a rug or artwork, or go just a couple of shades darker than the main wall color. This creates emphasis without being jarring or making the room feel visually chopped up.
Okay, moving into sort of the final layer of complexity here. Building the teams, the relationships, managing risk. Scale in this business rarely happens alone, does it?
Almost never. The sources really hammered this home. Durable success, whether it's real estate or anything else, is deeply tied to your network, your contacts.
Why is a broad network so important?
Well, the thinking is that the most successful businesses tend to have the biggest networks for two simple reasons. One, people generally like dealing with them. They're pleasant and fair.
Hmm.
And two, they're consistent. They stick around. They do what they say they'll do over a long period. Trust builds.
And in real estate specifically, who's the cornerstone of that network?
Your agent. A good real estate agent is foundational. But crucially, they need to understand the specific game you're playing. Are you flipping? Buying rentals? Commercial? They need to grasp the unique challenges and metrics of real estate investing, not just helping families buy their primary residence.
And they help build the rest of the team.
A great agent is the connector. They should know the reliable contractors, the responsive property managers, the investor-friendly lenders, the sharp inspectors in your market. They're your quarterback on the ground.
And for really accelerating growth, especially if you're starting without a ton of capital, partnerships seem key.
Absolutely. Leveraging partners is one of the fastest ways to scale. You might bring the deal-finding skills, the market knowledge, the management expertise.
And they bring the cash?
Often, yes. Or maybe they bring complementary skills. It allows you to do more deals, bigger deals, faster than you could on your own. But obviously, it requires excellent communication, clear agreements, and strong negotiation skills.
Let's dive into that negotiation piece. We looked at some pretty sophisticated psychological tactics, drawn even from things like FBI hostage negotiation, tactical empathy labeling. Tell us about those.
Yeah, these are powerful tools for influence. Tactical empathy isn't about agreeing with the other side or even necessarily liking them. It's about demonstrating that you understand their perspective, their feelings, their situation.
How do you demonstrate that?
Largely through labeling. That means verbally identifying and articulating the emotions you predict the other side is feeling. You might say something like, it seems like you're feeling frustrated with how long this process is taking, or it sounds like you might be worried about the inspection findings.
Just naming the emotion.
Just naming it calmly and respectfully. You're not judging it, just acknowledging it. It acts as a shortcut to intimacy, as one source put it. It shows you're paying attention, it lowers their offenses, makes them feel heard, and often gets them to reveal more about their true concerns. It's incredibly effective at de-escalating tension.
That's fascinating. And related to managing resistance, there was this counterintuitive idea about the word no. Great negotiators apparently seek no. Why?
It sounds backwards, right? We're trained to aim for yes, but think about it. When someone feels pressured into saying yes before they're truly ready, what often happens?
They might agree, but then back out later or resent it.
Exactly. False agreement. Buyer's remorse. No, on the other hand, often signifies that the real conversation is just beginning. When someone feels comfortable enough to say no to you, it means they feel safe, they feel in control. It paradoxically lowers barriers.
So you actually invite a no?
Sometimes, yes. You might phrase a question negatively, like, is now a bad time to talk about the offer? Or have you given up on selling this property? Getting the no to those questions actually means, yes, now is fine, or no, I haven't given up. It makes the other person feel empowered and often opens the door to their real objections and concerns, which you can then address. No isn't failure. It's often the start of genuine negotiation.
Okay, one more leverage tactic. Normative leverage. What's that about?
This one is about using the other party's own stated standards, principles, or past behaviors against them, gently but firmly.
How does that work?
You find an inconsistency between what they claim to value, maybe fairness, transparency, consistency, and what they're actually doing or asking for in the current negotiation. Nobody likes to be seen as a hypocrite. So if a company prides itself on long-term partnerships, but they're trying to squeeze you on a small point, you might say, given your company's emphasis on building strong, fair partnerships, this particular term feels a little out of step with that principle. Can you help me understand?
So you're holding up a mirror to their own standards.
Precisely. It frames your objection not as just your preference, but as something inconsistent with their self-image. It can be very persuasive if done respectfully.
All right, let's pivot sharply now to managing market risk and information. The sources were pretty skeptical about a lot of common investment analysis techniques, especially technical analysis for stocks.
Very skeptical. The consensus from the academic side, reflected in our sources, is that most technical analysis schemes looking at chart patterns, moving averages, things like short interest ratios, generally don't hold up to rigorous testing, especially after you factor in trading costs.
So chasing those patterns is likely futile.
The evidence suggests it's more noise than signal for most people. Similarly, beta, that traditional measure of a stock's volatility relative to the market, was flagged as not being a reliable predictor of long-run future returns. The focus really needs to be on understanding the underlying business, its fundamental value, its cash flows, rather than trying to time the market based on squiggly lines or simplistic metrics.
This skepticism seems linked to a really core, almost humbling concept in finance: the limits of arbitrage and solvency.
Ah, yes, the famous Keynes quote, essentially. The market can remain irrational longer than you can remain solvent.
Explain that. What's the lesson there?
Arbitrage is supposed to be the smart money exploiting temporary mispricings, buying something undervalued, selling something overvalued, expecting the prices to converge eventually. Rationality should prevail. But markets can be driven by fear, greed, momentum irrationality for surprisingly long periods. You might correctly identify that asset A is fundamentally cheap and asset B is fundamentally expensive. But if the irrational trend continues, asset A could get even cheaper and asset B even more expensive.
And if you're leveraged or have impatient investors.
You could run out of money. You could face margin calls. You could be forced to liquidate your correct position at a huge loss before the market ever comes back to its senses. The classic example is long-term capital management. The hedge funds stacked with Nobel Prize winners that blew up spectacularly in the late 90s because seemingly small rational bets went wildly wrong when markets seized up.
So the takeaway is, even if you think you're right based on fundamentals, you have to respect the market's capacity for madness and ensure you can survive it.
Exactly. You need a margin of safety. You need to manage your leverage. You need to understand your own solvency limits. Being right eventually doesn't help if you go broke first.
Okay, last piece of the puzzle. Connecting all this back to how we communicate. Whether we're marketing a property, raising capital, or just explaining our strategy. The story brand framework came up. What's the core idea there?
The core insight is simple but powerful. Most businesses and brands make the mistake of talking about themselves and selling solutions to external problems.
Like, we offer the best property management services.
Right, that's the external solution. But customers aren't primarily motivated by external problems. They're motivated by the internal frustrations those external problems cause.
Okay, unpack that.
So the external problem might be, my rental property toilet keeps breaking. The internal problem is, I feel stressed, overwhelmed, and incompetent because I can't keep up with repairs and I'm losing money. People buy solutions to resolve those internal feelings of frustration, confusion, or inadequacy.
So your message needs to connect with that inner feeling.
Absolutely. Your marketing, your communication needs to make the customer the hero of the story, not your product or service. You position yourself as the guide who understands their internal struggle and can give them a plan to overcome it and achieve success, which also resolves the external problem along the way. The message needs to be simple, clear, relevant to their pain, and easily repeatable. Focus on their transformation, not just your features. Hashtag tag outro effect.
Wow, we have covered a lot of ground today.
Yeah.
We really did try to synthesize a blueprint, didn't we? We went from the deepest level, defining your core identity, through structuring your effort with things like the 12-week year.
Then into the hard numbers, analyzing deals with metrics like cash-on-cash return, understanding valuation.
Navigated some really complex and important history about housing segregation and how it literally shapes the physical markets we operate in.
Touched on the nuts and bolts of management and staging.
And then layered on sophisticated tools for building teams, negotiation tactics like labeling and normative leverage, and managing market irrationality.
It really underscores the point that intentional success isn't random. It demands this integrated, focused approach. A plan that works not just in the business, but on the business and, crucially, on the self.
Absolutely.
And we've seen, haven't we, that wealth building is intrinsically tied to systems. Personal systems, financial systems, understanding market systems. The data showed the wealthy are accumulating more, yes, but they're often working incredibly hard and systematically to do it. So, the question it leaves for you, listening, is where are you choosing to direct your maximum effort? And how robust are the systems you're building to support that?
That's a powerful closing thought. And maybe one final provocative question for everyone to take away, building on that market risk discussion. We talked about how the market can stay irrational longer than you can stay solvent. So when you approach your next major decision, a big investment, a significant business move, anywhere you're putting substantial capital or reputation on the line, how will you rigorously, honestly distinguish between acting on solid fundamental analysis versus just hoping you can outlast what might be temporary market craziness? What's your process for telling the difference? And perhaps even more important, what is your personal, clearly defined solvency limit if you happen to guess wrong?